Hi, it's Pete Birchler here. It is July 31st before the market opens here in the U.S., and I wanted to go briefly over the last week's Commitment of Traders report and go over what I think that data is telling us. So first off, the Commitment of Traders report comes out on Fridays and carries data to the previous Tuesday. So the most recent report came out on the 26th, and what it contains is the data from the Tuesday of that week, so in this case the 23rd, back to the prior Tuesday. And I had anticipated this report as being potentially important because we saw in that time frame from the 23rd back to the 16th, we had seen the market push up to higher highs above this May high since then. So it attempted to break out. So what we want to do is when the market is pushing to new highs or important inflection points, especially when there's divergences showing up like we're seeing here, and I've covered in recent videos, as we want to see what the smart money is doing. Are they really increasing their selling as they move to these new highs? Are they attempting to kind of cap the market rally at this stage? And what we saw, if we click over to the COT data, so we saw a move up basically on Wednesday, Thursday, Friday, Monday, and then we saw a mild down day on Tuesday. So we had 4 out of 5 up days basically for the week. And as far as the COT data, we did see another increase in the net short position. So last week we saw a big jump in the net short, and then we saw another increase in the net short position. Now, this line would need to be all the way down here in this dark red zone to really be in the major sell territory, which is what I would think would be a stronger case as far as the bearish case. But understand that the smart money has gotten short at highs recently, and that's kind of their nature. These are hedgers, so as the market rises, they're going to tend to increase their net short simply as a hedge. That's how they function. They essentially treat the futures market as an insurance type of policy, and for them it's typically a net loss situation over the long term. So the research into the analysis of futures market would tend to suggest that the speculators are net winners and the hedgers are net losers. When you think about it, even though they're considered the smart money because they buy when prices are low and sell when prices are high, really it functions as an insurance policy for them, and you don't necessarily expect to be a net winner on your insurance policy. You just have it there in case of a disaster, and that's really how they use the hedges as. So over time they tend to lose money, but just understand that this is the normal pattern for them to increase their short position as the market rises. So I don't know how significant this is. I do think that this is the pattern we should see. Is we should see a relatively sharp increase in the net short position as we see a breakout. In order to give any strength to that, though, we'd basically need to see this breakout fail here, possibly maybe another slight push to new highs followed by a break back below the recent lows here of the last week or so. As far as the rate of selling, one way I track that is by basically a simple rate of change over the last several weeks. And whenever we see a large change in the COT index, basically in this how close they are to their maximum or minimum of their recent range. Whenever we see that change rapidly, that means they're really changing, they're rapidly buying or rapidly selling in a short period of time, basically. And this, as of this week's reading, with the last couple weeks showing some large increase in the net short position, we are seeing this jump up here, this rate of change. Now it's not to the maximum levels like we saw back in 2011. If we just go back here, we saw it really ramp up in going into the high of May of 2011, which led to that 21% correction going into October 2011. But we are seeing it approach the maximum that it has approached since then, which has typically led to maybe some stalling and some consolidation or more minor pullbacks in this uptrend since this past November. So something to be alert here. If we do see some continued selling throughout this week, coming into this weekend's report, especially if the market is actually not putting in any price gains, I think that would be another probably hint that this market is stalling here. So if the smart money is continuing to increase their net short, even though price didn't continue to rise, that would indicate that they're really forcing the market down. And so that's something we'll look for in the upcoming report. Another way I track this information is basically a proprietary way. I look at some of these different measures of absolute value in the COT data, and in addition to some rate of change measures. And when this indicator gets down below this line right here, this -50 line, that means they're really selling rapidly now. They only got to about -40 this week. So next week again, I think will be a key week. If we do see some increased selling, and let's actually put a little numbers on this here. So they're at -118,000 contracts in the S&P, Dow, and Nasdaq collectively. And what it's been the highest over the recent year or so has been around -130, so 130,000 contracts short. And if we go back into 2011. Yeah, even so, then it only got to around -100,000. So the actual peak, the most heavily short the smart money has been was on May 28th here, which was just the week after the recent May peak. So they're coming back up now, at -118,000, or excuse me, that was April 30th. Was the most heavily net short, and then they approached that again on May 28th. So those are numbers we'll want to watch here over the next week or so. If we see this continue to push up towards that -120 to 30 range, I think that would be very significant as far as the COT short level. So that's what to look for here. Understand here, based off of what I've talked about in the last couple updates, is we have this initial failed breakout pattern where prices pushed above this May high, closed above it for a couple of days, and then we saw a failure and it closed back below it, and price has tried to the last 4 days to close back above that May high and has really failed to do so. It's met resistance as it has met that 169 level on SPY. Today the market is set to open slightly lower. If we do break this low here from Friday, I think that could be significant in giving us some potential indication that this is a failed breakout. So for those who are understanding the technical situation here, the multi-time frame divergences, I think this is a possibility where one could enter short here with the stop either above yesterday's high or just above this support level, and then understand there's this gap here which could be an initial, there's a window here in candlestick terms, so one could look to either take partial profits, which would be roughly at a 1-to-1 reward to risk ratio at this 165.75 level as far as the fill of the window on the chart, which is the space between these two extremes of the candlestick, or actually looking at the fill of the gap here at 165.19 as an initial profit target to maybe sell half the position to create a break-even situation. If there is a breakdown here, sell half here and then set your stop somewhere closer to break-even, or even just leave it slightly above support and then initiate some type of trailing stop mechanism on the way down there. So That's an idea just for aggressively shorting here near the highs if we do see further weakness into the 167.50 level, which isn't a whole lot, just another 2/3% or so down. And the market looks to be opening maybe about a tenth to 2/10 down this morning. All right, so that's my take here. If there are any questions or comments, either drop those on the YouTube here or over at the blog at stockmarketalchemy.blogspot.com. With that, have a great day and all the best to your trading.